All right, members, this video is tailored just specifically to you. Thank you so much for supporting the channel, Trading Simplified. Definitely make sure you check out my members only videos. That's where this will go. Let's get into it. So we're going to create a 3-fund portfolio that's going to help you be more diversified. And let's get right into it. Let's start with the Fidelity 500 Index Fund. You can find this right on the Fidelity website, ticker symbol FXAIX. And we're going to go over in detail what this is and why I think this should be the cornerstone of your portfolio. If you're looking at the strategy here, it normally invests 80% of its assets in common stocks included in the S&P 500 index. The S&P 500 is the benchmark for all stocks, and everybody that tries to beat the market is comparing their gauge to the S&P 500. So what better way is to join the S&P 500? So let's take a quick look at FXAIX. Let's take a quick look at the 10 holdings that make it up. So you have Apple, Nvidia, Microsoft, Amazon, Meta, Google, Broadcom, Berkshire, Tesla, and some more Google. These 10 companies make up 34.89% of the total portfolio, and they are all stationed within this asset allocation of 100% domestic, meaning United States companies with a large blend of growth. When you break down the sectors, 30% of the S&P 500 is technology, financials is 14%, healthcare is 10%, consumer discretionary is 10%, communication services 9%, industrials 8%. This is a great way to start off your portfolio because you are well diversified and you are getting a very low fee. You're paying 15 cents for every $1,000 you have invested. That's a 0.015% expense ratio. When you look at the performance of this fund, FXAIX, and compare it to the S&P 500, it mirrors it. So purple is the Fidelity S&P 500 FXAIX at 18.39% it made last year compared to the S&P 500 18.41%. And when you look at the life of it, it's only off by a little bit of a percentage, 11%, 11.02% versus 11.15%. Buying a fund like this is giving you a well-rounded portfolio. You are buying 500 companies within the United States that is offering you well diversification. If you were to invest in this over 10 years, $10,000, right around here, your investment would now be worth $35,000. So you've had great appreciation. So this is a great fund to choose to round out your portfolio with low expense ratios. Now let's get into different sectors because when you buy, we're going to go over the next one, the next ETF. We are looking for a different style over here. You'll notice that this is a blend of basically value and growth. Now we're going to move to SCHD. This fund offers a different type of asset allocation. This is the Schwab US Dividend Equity ETF. And you will see when we go under composition here, you are going to find out that the companies are much different. SCHD offers Abbey, Coca-Cola, Amgen, Cisco, Pfizer, Verizon, Bristol, Chevron, Texas Instruments, Pepsi. These top 10 companies make up 42% of the fund, but the big thing with them is they offer dividends. Dividends to help grow your portfolio. So when you buy SCHD, you are getting a different asset allocation. You are getting a 3.49% dividend compared to FXAIX, the S&P 500 that pays just under 2% dividend. And when you look at the composition, you are also getting companies that are in North America. They're large and medium cap companies, but notice that it's more of a large blend. You have more exposure to financials at 17% compared to the 14-15% of S&P 500. Healthcare is higher allocation in SCHD at 17%, consumer staples at 14%, industrials at 12%, energy at 11%. So taking a look at SCHD, you have this US equity, passively managed, large value. Let's look at the performance so you can see how well this has performed. If you had a hypothetical growth of 2014 of $10,000, it would have grown to about $30,000. That is an excellent return. And when you compare it to the S&P 500 benchmark, which you can see right here, the last year SCHD returned 14% compared to S&P's 18% return. The life of the fund of SCHD has returned 13% year over year, whereas the S&P 500 has returned 14.78% year over year. When you invest in a company like this, or I should say an ETF, you are tracking the Dow Jones US Dividend 100 Index. So that is why you have a different allocation, and this will help diversify your portfolio. Definitely feel free to screenshot or pause it to just to get the sector exposure, or just type in SEHD under Fidelity to look this up as well. But the industry exposure is much different than your S&P 500. The last fund that I think will help diversify your portfolio is looking at Fidelity's International Index Fund, FSPSX. And what this does is gives you international exposure. And I want to show you the composition real quick before we get into the nitty gritty. This is all international equity. So we are not investing into the United States. What you are doing with this Fidelity International Index Fund, FSPSX, you are allowing yourself to invest in 737 holdings that are outside of the US. The regional diversification is in Europe, Japan, Asia, Pacific ex-Japan, and the US is only 0.07%. So if you look at the country diversification in more detail, Japan makes up 21%, United Kingdom 14%, France 11%, Switzerland 9%, and so on. So you are getting a very good diversification, and the NAV price starts at $52.53 at the time of this recording. If you were to invest $10,000 around 2015, it would be worth around $17,000, which is not as much gains compared to the S&P 500, but we don't know how international is going to perform over the long term. Let's look at the performance. The life of it gives you an average of 5%, 5.4% over the life of it. In the last year, it made 9.47%. It is trailing the S&P 500, but you got to remember it is viewing a different portion of the market. You also can look at the 10 years. It is 4 stars out of 5. And then looking at the composition just in a little more detail, international wise, you're getting a 22% allocation to financials, 17% to industrials, 12% to healthcare, 10% to consumer discretionary. Technology much lower at 8%. That kind of shows you where tech companies really are stationed, which is normally in the United States, at least the top biggest holdings. Looking at the fees and distributions, you're paying 35 cents for every $1,000 invested. That's a 0.035% ratio. And just looking at the overall NAV price, it is $52.53 at the time of this recording, and your initial investment is $0 to get started, so you could jump in at that rate. Thank you so much for supporting the channel. Always remember that I'm not a professional day trader or investor. You have to invest at your own risk. Always do your own research before buying and selling. This is my goal, is to provide you with other funds that are out there, to expose you to them, and then you do the research and decide what you want to do. If you're looking for a more detailed experience, you can go on the WAP, click on the link to become a member on there as well. And thank you so much for becoming a member on my YouTube channel. I really appreciate your support and videos like this to help you get a more personalized experience. Definitely check the tab on my channel for membership only videos. We are constantly posting videos on that as well to update you guys. Thank you so much for tuning in.